the AI boom may be losing its steam. Just days ago, AI-related chip stocks like Micron experienced a sharp decline, sending ripples across global markets. Here's an in-depth look at what happened and what it means for investors. In recent weeks, the financial markets have experienced a sharp reversal, particularly affecting technology stocks that focus on artificial intelligence hardware and memory sectors. This downturn has left investors in a state of heightened concern, as many had previously bet on continued growth in these areas. The market is currently undergoing a reassessment phase where growth expectations for these once high-flying stocks are being scrutinized. This shift follows a period of unprecedented enthusiasm surrounding AI advancements, which had driven valuations to dizzying heights. The upcoming jobs data, scheduled for release next week, will be crucial in shaping investor sentiment. If the figures indicate strong employment growth, it could signal a likelihood of near-term interest rate hikes, further exacerbating market volatility. The Federal Reserve, now under the leadership of Kevin Warsh, has adopted a hawkish stance in response to persistent inflation trends and geopolitical concerns, particularly those stemming from the ongoing tensions in the Middle East. Investors are increasingly wary of how these factors might impact economic stability and growth prospects. Should demand for AI technology fall short of expectations, there exists a tangible risk of a broader pullback in tech funding, which could lead to a significant downturn in the overall market. As investors grapple with these challenges, the pressing question remains: will AI technology regain its momentum, or are we facing a prolonged period of uncertainty? The implications of these developments are profound, not only for tech stocks, but for the broader economy. Looking ahead, the forthcoming weeks will be pivotal in determining whether the tech sector can stabilize and regain investor confidence. With critical economic data on the horizon, the next few days will likely set the stage for either recovery or deeper market turbulence. Investors must remain vigilant as these dynamics unfold. The groundwork for today's market turmoil has been laid over the past few years, driven by an unprecedented boom in AI technology. As companies raced to adopt AI solutions, the market saw record valuations, particularly in AI infrastructure and chip stocks. This surge fueled investor optimism, leading to a wave of tech investments that many believed would sustain high growth rates. However, as time progressed, cracks began to appear, revealing doubts regarding the sustainability of this AI-driven expansion. Recent geopolitical tensions, particularly surrounding the uncertain U.S.-Iran peace deal, have further contributed to a more cautious investor sentiment. This uncertainty is compounded by rising inflation rates, which topped 4% in May, marking a three-year high and adding to market volatility while increasing sensitivity to growth risks. Moreover, the AI sector itself appears to be hitting a natural ceiling. Processing fees for essential materials like copper have collapsed, yet prices for AI-driven products remain high. This disparity raises significant questions about the supply chain's capability to support ongoing AI advancements, potentially stifling innovation and slowing down the sector's growth trajectory. Historical trends indicate that previous euphoric moments in tech have often been followed by sharp corrections, and the current situation echoes such patterns. Key industry players now face intense pressure to deliver tangible results amidst growing skepticism from investors and analysts alike. Looking ahead, the market may enter a recalibration phase as investors reassess the long-term viability of AI-driven growth. Companies that can demonstrate sustainable business models and innovative solutions are likely to emerge stronger from this turbulence. As the market adjusts to these new realities, the future of AI technology and its impact on the economy will gradually become clearer. The recent downturn in artificial intelligence-related stocks has raised significant concerns among investors and market analysts alike. This decline follows a period of unprecedented growth, where AI spending was seen as the driving force behind a booming market. The Financial Times highlights that the enthusiasm surrounding AI technology may have created a bubble, with the potential for a prolonged investment downturn looming on the horizon. This situation threatens to unravel the impressive $4 trillion corporate profit boom that has underpinned the current market rally. Historically, AI has been viewed as a revolutionary sector, transforming industries from healthcare to finance. Companies heavily invested in AI technologies have enjoyed skyrocketing valuations, attracting both institutional and retail investors. However, recent reports indicate a slowdown in AI spending, causing alarm among those who have banked on continued growth in this area. The ripple effects of this downturn could lead to a significant pullback in tech funding, affecting not just the tech sector, but also the broader economy. The implications of declining tech stock values extend far beyond Wall Street. For the average consumer, a downturn in technology stocks may translate into slower job growth, as companies may be forced to cut back on hiring or even lay off employees in response to reduced funding. Additionally, lower consumer spending could follow as households face economic uncertainty, leading to a broader decline in economic stability. The interconnectedness of the tech sector with other industries means that a slowdown here could have a cascading effect, impacting everything from retail to manufacturing. Looking ahead, market analysts are closely monitoring these developments, seeking signs of recovery or further decline. The outlook remains uncertain, as investors weigh the potential for a rebound against the likelihood of continued challenges in AI spending. It is crucial for stakeholders to remain vigilant and adaptable in this rapidly evolving landscape. As companies reassess their strategies and investors recalibrate their expectations, the future of the tech sector will depend on its ability to innovate and respond to changing market conditions. The coming months will be critical in determining whether AI can regain its momentum or if broader economic challenges will stifle growth. On June 29, 2026, a significant shift occurred in the stock market as AI-related chip and memory stocks faced a steep decline. This downturn followed a marginal dip in the S&P 500 on June 26, with technology stocks bearing the brunt of the impact. Micron, a leading memory supplier, had previously enjoyed a surge in financial performance, largely due to big tech's willingness to pay exorbitant prices for AI memory. However, as investors began to question the sustainability of AI spending, the momentum shifted dramatically. Notably, optical and memory stocks experienced a sharp decline, as analysts reported that the most explosive hardware trades associated with AI had seemingly hit a wall. This sudden reversal in sentiment occurred amid broader global market dips, with major indices across Europe and Asia also reflecting investor apprehension. Concerns about inflation, rising interest rates, and geopolitical tensions have compounded the unease in financial markets. The Financial Times highlighted that this situation may signal the end of AI exuberance, raising fears of a lengthy investment bust that could significantly impact tech funding and the global economy. The recent boom in AI technology had led to unprecedented investment levels, creating a bubble that now appears to be deflating. Unlike previous downturns, this scenario is marked by an acute focus on AI's ability to sustain its growth, which has been the primary driver of market gains for several years. The implications of this downturn extend beyond the tech sector, as many companies had anticipated continued growth in AI demand to justify their valuations. Consequently, startups and established firms alike may face tightening capital conditions, leading to potential layoffs and reduced innovation. As analysts sift through the rubble, attention will turn to how quickly companies can adapt to changing market conditions. Investors may seek to reposition their portfolios, gravitating toward sectors less reliant on the volatile AI market. In the coming months, the industry will need to demonstrate its resilience and ability to evolve. The future of AI investments hinges on proving that sustainable demand exists beyond speculative enthusiasm. Companies that can innovate and pivot effectively will be better positioned to thrive in this new economic landscape. As we examine the future of AI and its impact on the market, what are your predictions? Will the AI sector bounce back, or is this the beginning of a downturn? Share your thoughts in the comments and subscribe for more in-depth analysis.